Imagine you're walking down the street and someone hands you a winning lottery ticket. But there's a catch. You have no idea how to cash it in, and if you wait too long, it literally turns to dust in your hands. That is exactly what the stock market feels like to most people. It is this massive, towering, chaotic machine of wealth that looks like a playground for billionaires and a complete death trap for regular people. We are told to invest, we are told to buy the dip, we are told that the stock market is the ultimate vehicle for financial freedom. But nobody actually sits you down and breaks it down without the confusing jargon, the toxic finance bro culture, and the endless spreadsheets. Today, we are stripping away all the noise. No complicated math, no boring economic lectures, and absolutely no fake promises. Just the raw, unfiltered truth of how the stock market actually works, how people make millions, how people lose their life savings, and how you can navigate it like a complete professional. By the time this 10-minute breakdown is over, you will understand the stock market better than 90% of the people trading on it right now. Think about your daily routine. You wake up in the morning and check your iPhone. That's Apple. You put on your favorite pair of sneakers. That's Nike. You grab a coffee from Starbucks, drive to work using gas from ExxonMobil, order lunch through Uber Eats, and spend your evening scrolling through TikTok or streaming a movie on Netflix. You are already spending your hard-earned money on these massive global corporations every single day. You are the reason they are making billions of dollars. But as a consumer, your relationship with these companies is completely one-sided. You give them your cash and they give you a temporary product or service. The stock market completely flips that dynamic. It changes you from a passive consumer into an active owner. When you buy a share of a company, you're not just buying a digital ticket or a flashing green number on a phone screen, you are buying a literal piece of that business. If a company has 1 million shares and you buy just one share, you legally own 1/1,000,000th of that entire corporation. That means you own a tiny piece of their factories, their technology, their brand, and most importantly, their future profits. When Apple sells 1 million new phones, a tiny fraction of that success belongs to you. When Microsoft signs a massive government contract, you win too. That is the fundamental core of the stock market. It is a marketplace that allows regular people to partner with the most powerful corporations on the planet. But how did we get here? Why do these massive, multi-billion-dollar companies want your money in the first place? Why don't they just keep all the profits for themselves? To understand that, you have to understand why a company decides to go public. Imagine you start a small bakery in your hometown. Your cookies are incredible, your coffee is perfect, and your shop is packed every single day. You're making great money, but you have a bigger dream. You want to open 10 more bakeries across the country. The problem is, building 10 new shops costs millions of dollars, and you simply do not have that kind of cash sitting in your bank account. You have a few options. You could go to a bank and take out a massive loan, but then you're buried under suffocating interest rates, and if the new shops fail, the bank will seize everything you own. Or you can turn to the stock market. You decide to divide your bakery business into pieces. You keep 51% for yourself so you can maintain total control, and you take the remaining 49% and offer it to the public. This process is called an initial public offering, or an IPO. Suddenly, everyday people can hand you $20, $50, or $100 in exchange for a tiny share of your bakery business. You take all that cash from thousands of different investors and you use it to build your 10 new locations. You didn't have to take massive bank debt, and the public now has a vested interest in your success. If your new bakeries thrive and the company grows, the value of those shares goes up. The people who trusted you early on can now sell their shares to someone else for a much higher price than what they paid for. This is the ultimate win-win scenario of capitalism. Companies get the massive amounts of capital they need to innovate, build, and expand, while everyday investors get a vehicle to grow their wealth alongside those companies. Now, once a company goes public, its shares don't just sit there. They are traded every single second of every single day on a stock exchange. In the United States, the two massive giants are the New York Stock Exchange on Wall Street and the NASDAQ. Think of these exchanges as the ultimate digital flea markets. Millions of buyers and sellers from all over the world gather here to trade these tiny pieces of companies. This brings us to the biggest question of all. What actually makes a stock price go up or down? Why is a stock worth $50 today, $70 tomorrow, and $30 next week? The answer is incredibly simple, yet most people completely overcomplicate it. It comes down to pure human emotion, driven by the laws of supply and demand. Imagine you have a rare, classic, holographic Pokemon card. If you're the only person in the world who owns it and nobody else cares about Pokemon, that card is completely worthless. There's no demand. But if suddenly a massive wave of nostalgia hits and thousands of wealthy collectors desperately want that exact card, the price will skyrocket. Why? Because the supply is strictly limited to just one card, but the demand is massive. Collectors will start outbidding each other, desperately offering more and more money just to be the one who gets it. The stock market works exactly the same way. There are only a fixed number of shares available for any given company. If a company releases an incredible new product, reports massive earnings, or announces a breakthrough technology, everyone suddenly wants a piece of that company. Demand explodes. But since the number of shares is limited, buyers have to bid higher and higher prices to convince existing shareholders to sell. That drives the stock price up. Conversely, if a company is caught in a massive scandal, loses millions of dollars, or faces an aggressive new competitor, everyone gets terrified. Fear takes over. Investors desperately want to get rid of their shares before the price drops further. But since everyone is trying to sell and nobody wants to buy, the sellers are forced to lower their prices more and more just to get someone to take the shares off their hands. That drives the stock price down. This constant tug of war between buyers and sellers, between greed and fear, happens in real time, millisecond by millisecond. It creates the flashing green and red lines that you see on financial news networks. But it's crucial to understand that in the short term, the stock market behaves like a giant voting machine. It reacts to rumors, headlines, tweets, and raw emotion. If a famous CEO says something controversial on a podcast, the stock might crash 15% in a single afternoon out of pure panic. But in the long term, the stock market behaves like a weighing machine. Over years and decades, the emotional noise fades away, and the stock price will inevitably reflect the actual value and profitability of the underlying business. If a company consistently makes billions of dollars in profit year after year, its stock will eventually go up, regardless of temporary market panics. When it comes to actually making money in this market, professionals generally divide themselves into two completely different camps: trading and investing. It is absolutely vital that you understand the difference, because mixing them up is the #1 reason why beginners lose everything. Let's talk about trading first. Trading is a fast-paced, high-stress, short-term game. Traders do not care about the long-term future of a company. They don't care if a company is going to change the world in 10 years. They only care about what the stock price is going to do over the next 10 minutes, 10 hours, or 10 days. They use a method called technical analysis, which involves staring at complex price charts, identifying patterns, and trying to predict short-term human behavior. Within the trading world, you have day traders who buy and sell stocks within a single day, never holding a position overnight. They look for tiny fluctuations in price, moving massive amounts of money in and out of the market to capture quick, small profits. Then you have swing traders who hold stocks for a few days or weeks, attempting to ride a specific wave of momentum. Trading can be incredibly lucrative, but it is also exceptionally risky. It requires intense discipline, lightning-fast execution, and an incredibly thick skin. It's a full-time job, a psychological battleground, and a statistical reality where the vast majority of amateurs lose their money to high-frequency algorithms and professional Wall Street institutions. Investing, on the other hand, is a completely different universe. Investing is a slow, patient, long-term game. Investors use a method called fundamental analysis. They don't look at flashing chart patterns, they look at the actual business. They study the company's financial statements, their revenue growth, their profit margins, their debt levels, and the quality of their management team. An investor finds an incredible company that is well managed and making great products, buys its stock, and then does absolutely nothing. They hold on to those shares for 5, 10, 20, or 30 years. Investors make money in two primary ways. The first is capital appreciation. This is the classic concept of buying low and selling high. If you bought shares of Amazon 20 years ago for a few dollars and held on to them while the company transformed global commerce, your shares are now worth an astronomical amount of money. The second way investors make money is through something called dividends. When a massive established company like Coca-Cola or McDonald's makes billions of dollars in profit, they don't always need to reinvest all of that cash back into the business. Instead, they take a portion of those profits and distribute them